You can argue about highlights. You can debate personalities. You can pick sides in comment sections all day long. But the market doesn't argue. It decides. And in 2026, the market just made one of the loudest decisions women's basketball has ever seen. A $50 million Gatorade deal. A signature flavor that crashed servers. Forbes calling her the most powerful female athlete on the planet. And a growing gap that's becoming impossible to ignore. This isn't about who talks the loudest on social media. It isn't about who trends for a weekend. It's about who moves product, who drives revenue, who makes billion-dollar corporations lean forward in their boardrooms and say, "That's the one," because brands don't gamble at this level. They don't hand out signature flavors like participation trophies. They don't restructure marketing calendars for fun. And they definitely don't attach $50 million to a rookie-era athlete unless they see something bigger than basketball. Something scalable. Something sustainable. Something that converts. And while one athlete was quietly building an empire brick by brick, another was watching it happen in real time. The Gatorade launch wasn't just a product drop. It was a signal flare. A message to the entire sports world that the hierarchy might have just shifted permanently. But here's the part people missed. The website crash? That was actually the smallest part of the story. Because what happened behind that launch tells you everything about where this rivalry, and this league, is headed next. And once you understand what $50 million really means in corporate terms, you'll realize this was never just about a drink. Gatorade has been in the endorsement game longer than most athletes have been alive. Michael Jordan drank it. Serena Williams fronted campaigns for it. LeBron built legacy ads with it. This is not a company that experiments casually. So when they decided to attach a reported $50 million partnership to Caitlin Clark, they weren't reacting to hype. They were reacting to data. Let's slow this down for a second. There's a massive difference between putting an athlete in a commercial and building a product around them. One is marketing. The other is infrastructure. Clark didn't just get a co-branded campaign. She didn't get a limited edition bottle with her face stamped on it. She got her own flavor. Rainberry. That detail matters more than most people realize. Because in the beverage industry, a flavor isn't a moment. It's a commitment. It becomes a permanent SKU, a stocking unit, that retailers reorder based on velocity. If it doesn't move, it disappears quietly. If it explodes, it becomes shelf space gold. Gatorade revived a flavor she reportedly loved growing up, customized it, and built the entire identity around her brand aesthetic. The color palette, the design language, the rollout timing. That's not surface-level endorsement energy. That's integration. And then launch day hit. Within minutes, the site buckled. Fans were posting screenshots of error pages. Carts froze. Pages timed out. Inventory disappeared before most buyers even refreshed. Now here's what matters. Website crashes don't happen because of casual interest. They happen because demand exceeds digital infrastructure thresholds. That's measurable traffic, real purchasing behavior, credit cards attempting to process. And here's the deeper layer. When a brand like Gatorade monitors a launch, they aren't just counting clicks. They're tracking geographic purchase spread. They're watching whether demand clusters in basketball-heavy markets or spreads nationally. Early retail indicators reportedly showed something powerful: crossover buyers. People who don't watch WNBA games were buying Rainberry. People who didn't own a Clark jersey were picking up that bottle at checkout. That's mainstream penetration. And mainstream penetration is where endorsement multipliers explode. Because once an athlete's appeal leaves the sport and enters general consumer culture, valuation models change. Suddenly, you're not just a basketball player. You're a distribution channel. And here's the part that should make every analyst pause. Gatorade didn't need to do this. They already have an established roster of elite athletes. Global icons, championship resumes, household names. They didn't lack star power. They chose Clark. In corporate strategy meetings, that decision doesn't happen emotionally. It happens after months of retail tracking, social engagement analysis, merchandise velocity studies, and demographic overlap modeling. Translation: they studied the Fever's ticket spikes. They watched TV ratings climb. They saw jerseys sell out. They observed resale prices climb. They analyzed sentiment consistency. Then they made a calculated bet. $50 million isn't hype money. It's forecast money. It means internal projections are predicting sustained growth. Multi-year cultural staying power. expansion into adjacent markets. And when a company that size locks in that kind of number, it sends a message to every other brand watching. The ceiling just moved. But here's where the ripple effect begins. Because in professional sports, endorsement dominance doesn't exist in isolation. There are always comparisons, always contrasts, always someone standing on the other side of the narrative. And while Rainberry was flying off digital shelves, another signature product was sitting still. But that contrast? That's where this story really turns. And what happened next made the gap impossible to spin. One massive deal can be dismissed as hype. Two deals raise eyebrows. But when four legacy brands, in completely different industries, move in the same direction at nearly the same time, that's not coincidence. That's convergence. And convergence only happens when corporations see the same numbers. Because before Rainberry ever crashed a server, before headlines screamed about $50 million, the foundation had already been laid. Quietly, strategically, relentlessly. Let's start with Nike. The reported 8-year deal worth around $28 million wasn't just the biggest shoe endorsement in WNBA history. It reset the scale entirely. Not slightly higher, not incrementally better. A new tier. But the real story isn't even the contract value. It's what's coming next. The signature shoe. Nike does not hand out signature shoes casually. A signature line means design teams, production pipelines, global marketing campaigns, retail allocations, athlete storytelling arcs, and long-term positioning strategies, all centered around one name. You don't get that treatment unless projections show global traction. Think about what a signature shoe represents historically. It's not just footwear. It's identity. It's lifestyle branding. It's youth market penetration. It's resale markets. It's international licensing. Jordan Brand didn't become Jordan Brand overnight. It started with belief. Then it multiplied. Now, no one is saying Clark equals Jordan in legacy. That's not the point. The point is Nike is treating the infrastructure the same way. And here's what most fans miss. Nike runs predictive modeling years ahead of launch. They simulate sell-through velocity. They analyze social engagement conversion rates. They forecast manufacturing quantities based on projected demand curves. Early analyst whispers are already projecting instant sellouts once the shoe drops. And the shoe hasn't even been revealed yet. That's anticipation equity. That's cultural runway. And that's only one pillar. Now layer in Wilson. There is exactly one modern athlete before Clark who had a signature line with Wilson at that magnitude. Michael Jordan. Wilson doesn't flood the market with athlete-branded permanent product lines. They are selective to the point of being conservative. So when they chose to create a lasting product ecosystem under Clark's name, it wasn't emotional. It was calculated brand alignment. Permanent product lines mean long-term shelf presence. They mean annual production cycles. They mean your name becomes part of a catalog, not just a campaign. That's legacy positioning. Then there's State Farm. This might actually be the quietest, but most revealing move of all. State Farm has partnered with major male athletes across the biggest American sports for decades. Football, basketball, baseball, but never a female athlete. Until now. And that tells you something about demographic crossover. Insurance marketing isn't targeted at teenagers. It's household-based. It's family-based. It's income-based. State Farm doesn't sign someone because they trend for a week. They sign someone who resonates with broad consumer trust. That's image stability. That's long-term relatability. That's brand safety at scale. So when you stack it, Nike, Wilson, State Farm, Gatorade, for legacy giants in footwear, sporting goods, insurance, and beverage, all investing long-term within a 2-year window. That's not hype alignment. That's ecosystem construction. And here's the part that shifts the entire conversation. Clark is still on a rookie-scale WNBA contract. Her base salary doesn't even remotely reflect her total value, which means her off-court earnings are doing the heavy lifting, reportedly crossing into 8-figure territory during her rookie era. That's not normal. That's not incremental growth. That's market correction. Because what brands are signaling through these deals is that they believe her commercial impact extends beyond the WNBA audience. And when that happens, something powerful kicks in, compounding momentum. Here's how compounding works in branding. Brand A signs you because they see potential. Brand B sees Brand A's move and validates their own projections. Brand C sees two legacy brands moving and accelerates negotiations. Brand D jumps in to avoid missing the wave. Suddenly, momentum feeds itself, and perception shifts from rising star to industry anchor. That's where Clark sits right now. She's not being marketed as a promising athlete. She's being marketed as a pillar. And once that positioning locks in, it becomes extremely difficult for competitors to disrupt. Because corporations don't pivot quickly once infrastructure is built. Factories get tooled. Campaigns get planned. Retailers allocate space months in advance. This isn't social media momentum. This is supply chain momentum. And supply chains don't run on emotions. They run on forecasts. Which brings us to something uncomfortable. Because while one athlete's ecosystem was expanding, another athlete's rollout was encountering friction. Not in headlines, not in interviews, but in something far more important: retail reality. And once that contrast becomes visible side by side, narratives get a lot harder to control. But the real shift didn't happen when the deals were signed. It happened when independent financial publications stepped in and removed opinion from the equation entirely. And what those rankings revealed, that's where this turns from rivalry into separation. A signature shoe is supposed to be a coronation. It's the moment a brand plants its flag and says, "This is our future." It's validation. It's leverage. It's long-term belief in physical form. So when Angel Reese signed with Reebok and the announcement dropped, the energy was loud, confident, competitive. The timing felt intentional. It landed in the same broader era where Clark's Nike deal was dominating headlines. And the positioning was clear. Reebok had its own star, its own face, its own counterweight. That's smart branding on paper. But paper projections don't matter once the product hits shelves. Because retail is ruthless. And retail does not care about rivalry narratives. It cares about velocity. Let's talk about what velocity means. When a shoe launches, brands track first-week sell-through. They measure how quickly inventory moves relative to how much was shipped. They watch whether stores request restocks. They analyze online waitlists. They study resale activity. Hot product equals urgency. Urgency equals pricing power. Pricing power equals leverage. But when a product doesn't generate urgency, retailers adjust. And adjustments are quiet, but telling. Discount tags start appearing. Promotional bundles pop up. Featured placement disappears. Marketing push softens. Now here's the important nuance. Discounting does not mean failure. But early discounting on a signature product signals something very specific. Projected demand didn't meet actual demand. And in the footwear business, that gap matters. Because footwear margins are tight. Brands allocate marketing budgets based on performance. If early sales don't match internal targets, promotional focus shifts to products that are converting better. Momentum moves elsewhere. And here's where the contrast becomes impossible to ignore. Clark's Nike shoe hasn't even launched yet, and analysts are already forecasting immediate sellouts. Media outlets are speculating about resale markets. Sneaker blogs are tracking potential drop windows. That's pre-release anticipation. Meanwhile, Reese's shoe has been available. Availability without urgency creates a perception problem. Because hype is strongest before launch. If the energy dips after release, it becomes harder to rebuild. And here's something even more significant. Brands don't just track sales numbers. They track sentiment. They monitor social conversation tone. They evaluate whether press cycles trend positive or polarizing. They measure whether the athlete's public narrative aligns with long-term brand image. This is where things get complicated. Over the past 2 years, the rivalry narrative has been one of the most talked about storylines in women's basketball. Competitive tension drives engagement. Engagement drives clicks. But tension can be a double-edged sword. If the rivalry feels competitive, brands love it. If it starts feeling personal, reactive, or antagonistic, brands get cautious. Because global corporations avoid volatility. And perception matters. Reese has built a powerful, unapologetic public identity. That's part of her appeal. It resonates with her core audience. It creates loyalty. It drives conversation. But loyalty and conversion are different metrics. And some reports have suggested that certain sponsors have become more careful in evaluating long-term commitments tied to controversy cycles. That doesn't mean doors are closing. It means risk models are updating. And when a brand like Reebok pulls back on marketing intensity after launch, even subtly, that's not random. Marketing budgets follow performance. Silence from a brand after a major product drop usually signals reassessment. Because signature shoes are expensive to produce. Inventory planning happens months in advance. If sell-through underperforms projections, brands slow promotion while recalibrating strategy. That's not drama. That's business. Now zoom out. On one side you have a beverage launch overwhelming digital infrastructure, a forthcoming Nike signature shoe-building pre-release buzz, a permanent Wilson line, a historic insurance partnership. On the other side, a signature shoe rollout facing slower-than-expected retail heat, marketing volume decreasing post-launch, narrative focus leaning heavily on rivalry instead of independent brand expansion. That contrast isn't social media bias. It's structural momentum, and momentum in commerce compounds. Here's what most people underestimate. Once one athlete becomes seen as the safer long-term investment, brand clustering accelerates around them. It's not about personality preference. It's about predictability. Corporations prefer predictable growth curves. Clark's brand arc has followed a clean upward trajectory. Performance headlines, record-breaking games, professional interviews, cross-industry partnerships, consistent tone. Reese's arc has been louder, more emotionally charged, more rivalry-centered. That works for engagement. But engagement doesn't always equal stability. And stability is what $50 million deals are built on. Now, none of this means Reese can't rebound commercially. But right now, the data trend lines aren't parallel. They're diverging. And when divergence becomes measurable, independent publications step in. Not blogs, not fan pages, financial analysts. And when those rankings dropped, the rivalry narrative suddenly looked a lot smaller than the revenue gap. Because this is the moment the story stops being about personality and starts being about power. And what Forbes revealed next turned speculation into documentation. For months, the conversation lived online. Highlight clips, post-game quotes, side-by-side comparisons, fan wars. It felt loud, but loud isn't always clear. Then Forbes stepped in. And Forbes doesn't care about who trends for a weekend. They measure power, not personality, not potential. Power. When they released their rankings and named Caitlin Clark the most powerful female athlete in the world, it wasn't framed as praise. It was framed as an evaluation. That distinction matters. Because Forbes rankings aren't popularity contests. They analyze sponsorship valuation, economic ripple effect, cross-industry reach, and measurable influence across commercial ecosystems. In other words, who moves markets. Clark didn't just land on the list. She landed at the top among active female athletes. Let that sit. Above veterans. Above international stars. Above athletes with championships already secured. And here's what makes it even heavier. The only names above her overall were executives, owners, organizational power brokers. Meaning among players actively competing, she stood alone. That's not narrative spin. That's market positioning. Now look deeper into what pushed her there. Reported off-court earnings in her rookie season reportedly crossed into eight-figure territory, over $11 million. For context, most first-year WNBA players historically never even approach that figure across multiple seasons. Her base salary remained modest under rookie scale, which means brands were driving the total valuation. When your endorsement income eclipses your league salary by that margin, it sends a signal. Sponsors are valuing your reach more than your contract. That's commercial gravity. And Forbes tracks something else that people overlook, conversion quality. It's not just about follower count. It's about how many of those followers respond when a product launches. Do they click? Do they buy? Do they share? Do they show up? Rainberry crashing servers? That's conversion. Ticket prices spiking for fever games? That's conversion. Merchandise surging? That's conversion. Cross-sport collaborations drawing new demographics? That's expansion. Forbes measures expansion. Now here's where the separation becomes uncomfortable. Angel Reese, despite high visibility and strong social presence, was absent from that ranking. Not placed lower. Not listed further down. Absent. And absence in a financial ranking doesn't mean irrelevance. It means the measurable economic footprint didn't reach the threshold required for inclusion. That's a data gap. Then Sportico added fuel. They named Clark the highest-paid player in the WNBA. Remember, she's still on a rookie-scale contract. So this wasn't about salary negotiations. It was about total earnings, which means endorsements alone elevated her above veterans with larger base salaries. That's rare, because normally, league longevity determines income hierarchy. Clark disrupted that hierarchy immediately. And when two independent financial publications, not sports talk shows, align in their findings, the conversation shifts. This is no longer about who talks more. It's about who converts more. And once the market establishes a hierarchy, brands respond accordingly. Investments flow toward the perceived growth center. Retailers allocate more space. Marketing dollars cluster. Media cycles amplify. Momentum compounds. Meanwhile, the gap widens. And widening gaps create tension. Because rivalries thrive on perceived equality. If both sides feel balanced, debate sustains itself. But when financial documentation shows divergence, the rivalry narrative starts feeling uneven. One athlete becomes an expanding commercial infrastructure. The other becomes framed through contrast. And that's where perception shifts. Now here's something important. This isn't permanent. Sports are unpredictable. Careers evolve. Momentum swings. But in this moment, right now, the market has issued its assessment. And the assessment says one trajectory is accelerating faster. Which brings us to the final layer. Because this was never just about individual deals. It's about what happens when commercial dominance starts reshaping an entire league's ecosystem. And if this trend continues into the next season, the ripple effects won't just impact two athletes. They'll impact the entire power structure of women's basketball. And that's where this story becomes bigger than rivalry. It becomes transformation. At some point, every sports rivalry hits a crossroads. Either it stays competitive, or it becomes structural. And what's happening right now doesn't feel like two athletes trading headlines. It feels like an economic shift. Because when endorsement dominance compounds the way it has for Clark, it starts changing how an entire league is valued. Think about it. When one player consistently spikes ticket demand, television ratings, merchandise sales, and sponsor interest, that influence doesn't stay isolated. It lifts franchise valuations. It strengthens broadcast negotiations. It gives the league leverage in future media rights talks. It creates proof of concept. And proof of concept is everything in professional sports economics. For years, brands claimed they were waiting for the right moment to go all in on women's basketball at scale. Now they have measurable evidence. Games selling out. Websites crashing. National ad campaigns converting. Insurance companies entering the space. Legacy footwear brands building signature pipelines. That's not symbolic support. That's capital allocation. And capital allocation follows predictability. Here's where this becomes uncomfortable for competitors. When corporations begin structuring multi-year campaigns around one central athlete, they aren't just investing in the present. They're forecasting cultural stability. They're asking, who will still be marketable 5 years from now? Who can represent us globally? Who expands our audience instead of dividing it? Clark's public image, polished, composed, media-trained, aligns cleanly with that model. That doesn't mean Reese lacks value. Far from it. Reese brings personality, boldness, emotional fire, a devoted base that rides hard. But emotional fire and corporate comfort don't always overlap perfectly. And corporations, especially billion-dollar brands, prioritize comfort. Not because they dislike intensity, but because volatility makes projections harder. And projections determine budget size. So what we're witnessing isn't just one athlete winning endorsements. We're witnessing infrastructure being built. Factories tooled for signature shoes. Flavor lines integrated into retail supply chains. Multi-year commercial scripts written and storyboarded. Cross-industry campaigns scheduled months in advance. Once that machine starts turning, it doesn't slow easily. It feeds itself. Each successful launch strengthens the next negotiation. Each ranking reinforces the next brand pitch. Each sellout raises the perceived ceiling. Momentum compounds. And compounding momentum is almost impossible to interrupt unless something dramatic shifts the trajectory. Which raises the real question. If Clark's Nike shoe launches the way analysts expect, instant sellout, resale buzz, global conversation, what happens next? Another extension? International expansion? More non-sports partnerships? Because once an athlete crosses fully into mainstream commercial identity, their sport becomes the platform, not the limit. That's when valuation models explode. And that's when rivalries fade into footnotes. Now zoom out to the fever. The roster isn't built around one headline. Lexi Hull, Aaliyah Boston, Kelsey Mitchell, Sophie Cunningham. There's competitive depth there. If on-court success aligns with off-court dominance, the multiplier effect intensifies. Winning accelerates endorsement power. Endorsement power increases exposure. Exposure increases fan acquisition. Fan acquisition increases revenue. It becomes a flywheel. And once a flywheel gains speed, it takes enormous force to stop it. Meanwhile, any athlete on the opposite side of that flywheel faces a choice. Lean into independent identity expansion, build outside the rivalry narrative, or continue framing value through contrast. Because here's the uncomfortable truth. When public perception begins to frame one athlete as the economic engine of a league, comparisons start feeling less like competition and more like resistance. And resistance rarely beats momentum. Now none of this means Reese's story is over. Careers pivot. Brands reposition. Breakout seasons happen. But right now, the data shows divergence. One trajectory accelerating. One recalibrating. And the market, not fans, not commentators, made that call. That's why the Gatorade deal wasn't just a sponsorship. It was a signal. The Nike shoe isn't just footwear. It's infrastructure. The Forbes ranking wasn't praise. It was documentation. And documentation changes narratives. Because narratives can be debated. Documentation cannot. So when people ask, are you Team Caitlin or Team Ree? Maybe that's the wrong question. Maybe the better question is, are you betting on noise or numbers? Because the numbers are building something bigger than a rivalry. They're building a new commercial blueprint for women's basketball. And if this blueprint holds through the next season, we might look back at this moment as the exact point where the hierarchy shifted permanently. Not emotionally, economically. You can debate personality. You can debate play style. You can debate who talks more. But the market doesn't debate. It converts. It tracks. It invests. Right now, the investments are stacking in one direction. $50 million flavor launches. Signature shoe anticipation. Historic brand partnerships. Financial rankings backing it all up. That doesn't happen by accident. And it definitely doesn't happen overnight. This story isn't finished. In fact, it's probably just beginning. Because the real test isn't one deal. It's whether the next launch hits even harder. If you want the real business behind the headlines, not just the drama, make sure you subscribe. Because what's coming next in this league might redefine who holds power for the next decade. And when the next major deal drops, you'll want to understand what it really means. Now tell me, is this still a rivalry? Or has the market already decided?